It starts quietly. Not with sirens. Not with shouting. Just a message. A bank somewhere, in some city, says it can't pay its bills. And suddenly, a chain of people, companies, even countries, are holding empty envelopes. You think your money is safe. You think your paycheck, your savings, your investments, they're all protected. But when everything breaks, there's a very strict line. And most people aren't even on it. This is who actually gets paid first. It matters now more than ever. Because the world has more debt than ever before. Trillions stacked on trillions. Governments borrow. Banks lend. Corporations promise. And it all rests on faith that everyone will play nice. But faith isn't cash. And faith doesn't pay the rent. So, what happens when the faith falters? Let's start small. Imagine a company. Big, recognizable. They owe money to suppliers, employees, and a bank. The bills come due. Cash is short. Who gets the money first? The bank. Always the bank. It's not mean. It's not conspiracy. It's law and contracts. Banks and secured creditors have first dibs. Everything else, suppliers, investors, employees, get in line behind them. And the line can be terrifyingly long. Now scale this up. Think bigger, entire financial markets, countries owing other countries. It works the same way. Governments issue bonds. Banks lend to companies. Hedge funds lend to banks. And everyone bets that the system holds. When panic hits, the same hierarchy applies. Big, secured creditors. Then smaller creditors. Then everyone else. This is why during the 2008 financial crisis, some CEOs walked away with golden parachutes while ordinary homeowners lost everything. The math is simple. Trillions of dollars. One default. Only a fraction of obligations can be honored immediately. The rest? Sorry, you're behind the line. Here's the ironic part. The people most connected to the problem often benefit first. Not the people who took the risk carefully. Not the people who followed the rules. Those who lent recklessly to the biggest players often end up getting paid first, even if they were wrong. Meanwhile, employees, pensioners, and small investors sit and watch. And they wait. Let's break down a real example. During Lehman Brothers' collapse, billions of dollars were owed across the globe. Who got paid first? Counterparties with secured claims, large banks in London, New York, Tokyo. Who suffered the most? Unsecured creditors. Employees. Ordinary shareholders. And yet, media headlines were full of market chaos, fear, and uncertainty, hiding the fact that the richest players were already getting their money. The uncomfortable math. A bank owes $100 billion. It can only pay $60 billion immediately. The law decides the order. Secured creditors get $50 billion. Priority creditors get $5 billion. That leaves $5 billion for everyone else combined. If you were an employee or small investor, your claim might vanish entirely. That's not hyperbole. That's exactly how it works. Contrast that with the hype we're fed. The system is safe. Deposit insurance protects you. The economy will bounce back. Mostly true, but only if you're near the front of the line. For everyone else, the system works, just not in their favor. And the higher the stakes, the more the system favors the insiders. Zoom out. This is not just banks or corporations. It's entire countries, entire financial networks. Debt chains link continents. A default in one country can ripple across the globe in hours. Yet, in every crisis, the hierarchy holds. Secured claims first. Secured claims always first. And the rest? We watch. Hoping there's enough left. So next time you read about a market crash, a government debt crisis, or a corporate bankruptcy, ask yourself. Who's actually getting paid first? And maybe even more unsettling. Are you on that list? Because when the system breaks, knowing where you stand isn't just curiosity. It's survival. And the answer isn't simple. It's structured. Legal. Mercilessly precise. And for most people, invisible until it's too late. The line keeps moving. And history shows, it always will.